Hello, welcome to this session on marginal costing. Here we'll be discussing the details about what marginal costing is and how different it is from absorption costing. Now, basically, what you need to understand is when we talk about marginal costing is nothing but the cost of manufacturing one extra unit, right? So, for example, if you are already manufacturing 100 units and you need to make one more additional unit, what is the additional cost that you incur? You won't be incurring any additional fixed cost. You won't be incurring any additional overheads unless they are variable. The only additional cost that you will incur are the labor cost probably or the material cost, which are also variable costs. Therefore, marginal cost is also known as variable cost or vice versa. The variable cost is the marginal cost. To give you one more example, suppose I have a class batch of 100 students. I'm paying rent. I'm also providing notes to the students, right? So if I already have 50 students, if I get one additional student, the only additional cost that I'm going to incur is the cost of those notes, right? So that will be the marginal cost. So as per the definition of marginal costing, it is the cost incurred in manufacturing one additional unit. In this case, when we prepare the income statement under marginal costing, we basically bifurcate the cost between variable cost and the fixed cost. So we always start the income statement under marginal costing looks something like this. Sales followed by all variable costs. So first you will have all the variable cost in manufacturing, that is direct material consumed, direct labor, variable manufacturing overheads. This will give you the cost of goods produced. You will add the opening stock of finished goods valued at the cost of the previous period. Generally, the fixed cost under marginal costing are valued at only the variable cost. Please remember, the closing stock under marginal costing is always valued with variable cost only, and closing stock of finished goods valued at current variable cost. This is again value at the cost of the previous period, which is again going to be variable cost. This will give you the cost of goods sold. To that you will add the variable administration, selling, distribution overheads to give you the total variable cost. This, after you subtract all the variable costs from the sales, you will get contribution. So basically, contribution is towards recovering the fixed cost. From the contribution, you will subtract the fixed cost, whether it is production, admin or selling and distribution fixed cost, to get the net profit. Now please remember that under marginal costing, fixed costs are treated as period cost. That means they will be charged in the same period that they are incurred, right? Therefore, all the fixed costs incurred in that period will be subtracted from the contribution to arrive at the profit. As against this, when you compare the marginal cost with the absorption costing, you start with the sales, then you subtract all the production cost including the fixed manufacturing overheads to get the cost of production. From that you will adjust the opening and the closing stock to arrive at cost of goods sold. Then you will have a calculation or a adjustment for over absorption or under absorption. Then subtract the administrative and selling distribution costs to arrive at the profits, right? So you need to understand the difference between absorption costing, where the fixed costs are charged at each level, that is production cost, selling and distribution cost or admin cost, etc. So there is no differentiation between variable cost and fixed cost under absorption costing, but under marginal costing, remember, first you will subtract all the variable costs and then arrive at contribution. From contribution, you will subtract the fixed cost to arrive at the profit. It is not necessary. The profits under absorption costing and marginal costing may differ. Now, the important concepts that you should know when you're discussing marginal cost. Now contribution is selling price minus variable cost, as I told you before. So from contribution, if you want to arrive at profit, contribution minus fixed cost will give you the profit. Therefore, contribution is equal to fixed cost plus profit. I have just rearranged these equations. Therefore, selling price minus variable cost is going to be equal to fixed cost plus profit. So again, if you rearrange this, you will get selling price minus variable cost minus fixed cost will give you profit, right? So this variable cost and fixed cost is nothing but your total cost. So all you need to understand is what is contribution, how to arrive at profit from the contribution. Going ahead, profit volume ratio or contribution sales ratio. So PV is the same as CS. Contribution upon sales into 100. This is also known as PV ratio, or it is also known as the CS ratio. Therefore, if you rearrange this, sales will always be equal to contribution upon PV ratio. Remember, PV ratio is equal to contribution upon sales into 100. So if you want to find out the sales, then you rearrange this, and sales is going to be contribution upon the PV ratio into 100, right? PV ratio is same as contribution to sales ratio. Basically, what this tells you, now let's say for example, your CS ratio is 30%, okay, or your PV ratio as you call it is 30%. What it means is that if you have a total sales of 100, out of that 30 is going to be contribution and 70 is going to be your variable cost. This is how you can also interpret it. If your CS ratio is 60%, that means from the sales, contribution is 60 and variable cost is 40. Please understand these concepts, or remember these concepts. It will help you later when you do management accounting. Now coming to break-even point. Now break-even point is a point of sales where there is no profit, no loss. That means you not only recover your variable cost, but you also recover your fixed cost. Now let me explain this graph. On x-axis is the units, on y-axis is the cost and revenue. As you can see, fixed cost is parallel to the x-axis. Total cost will start where the fixed cost, at the point where fixed cost meets the y-axis, right? Because total cost consists of fixed plus variable. At 0 units, variable cost is going to be 0. Therefore, the starting point for total cost is going to be at fixed cost. Sales, if your 0 sales, then sales line will start at point 0, and this is your total sales. The difference between total sales and the total cost is going to be your profit or loss. Now, this shaded area, which I'm marking with red, the sales line is below the cost line. That means in this case, sales is less than the cost. So this is your loss area, right? At this point where sales and cost is the same, this is known as the BEP point, that is the break-even point. So BEP, if you sell these many units, you will recover all your cost. This is represented in units, and if you join it on the y-axis, you will get it in rupees. Anything above, now from this point onwards, sales will become greater than cost, right? So anything above that will be your profit area, right? And this angle is known as angle of incidence. So break-even point is the volume of production or sales where total costs are equal to the revenue. BEP is calculated as fixed cost upon contribution per unit. If you want to calculate how many units you need to sell to recover all your cost, then fixed cost upon contribution per unit. Basically, contribution per unit, when you divide it, it tells you how many units you need to sell to recover your fixed cost. So that is your BP. But if you want it in rupees, in that case, you will divide the fixed cost with the PV ratio or the CS ratio so that you will get the BEP sales in rupees. Now, this angle of incidence that I told you about, the angle is formed by intersection of total sales and total cost line. Larger the angle, rate of growth of profit would be higher and vice versa. Now, sometimes there cannot be a linear relationship between sales and cost, right? In that case, non-linear break-even chart will look something like this, right? So, in some cases, on account of non-linear behavior, the cost and sales, there may be two or more break-even points. In such a case, the optimum profit is earned where the difference between the sales and the total cost is the largest. So, this is where the profit would be the highest, right? So, otherwise, there could be multiple break-even points. Margin of safety. It is the sales point beyond the BEP, break-even point. So, margin of safety is total sales minus the break-even sales, or sometimes you are given the estimated or the budgeted sales, right? So, estimated sales minus the break-even sales will give you margin of safety. Margin of safety or MS ratio is profit upon profit volume ratio. This is another formula that you need to remember. Profit is equal to total sales multiplied by PV ratio multiplied by the MS ratio. Sales value to earn the desired profit. Now remember, when we talked about the BEP point, break-even point, we divided fixed cost by the contribution per unit, right? So basically, how many units need to be sold to recover the fixed cost? Now suppose along with the fixed cost, you also need a certain required profit, let's say 10,000 rupees, right? So in that case, what should be the number of units to be sold? So the formula here is very simple. So you not only need to recover your fixed cost, but you also need to earn 10,000. So the formula is fixed cost plus desired profit divided by either contribution per unit to get the quantity, or if you divide it with PEP ratio, you will get the sales in amount. Required units to earn the desired profit is again fixed cost plus desired profit into contribution per unit. Shut down sales. So if you need to shut down the sales, when should you shut down? So in that case, fixed cost minus shutdown cost divided by PV ratio. The level at which profits are the same or level at which costs for two different alternatives are same is calculated or known as indifference point. So sometimes the variable cost is less, fixed cost is more. In another alternative, variable cost is more, fixed cost is less. So which is the point of indifference? So whichever method or alternative use, at what level will the profit be the same? That is known as indifference point. So indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. We'll be taking up examples in the next video. Thank you.